Welcome to Tech Talk Tuesday. I'm your host, Carla, and with me is my fellow co host and CMT, David Blake. It's Tuesday, January 16th, 2024, and we have some activity to talk about that happened in the stock market last week, along with some interesting things to look out for moving forward. We do it from a technical perspective. David, I hope that you had a great extended weekend. How are you doing today?
I'm doing well. Thanks for asking. I'm doing well.
Great. Well, let's get started by taking a look at last week's market letter.
All right, we had kind of actually, I had an up week last week, but it wasn't all that it was meant to be. Once again, we had the big cap technology shares outperforming. The Nasdaq actually was up about 3%, but the rest of the indexes, the Dow Jones, the S&P, were up marginally, and then we had the Russell 2000 down for a third consecutive week. So that's something that we call negative divergence when the other indexes are going up and the transports and the small caps, which we'd like to see lead the market higher and lower, are actually drifting lower. So we started off the week with a big Monday. We had Nvidia and Advanced Micro Devices kicked off this tech rebound on Monday. The Nasdaq actually surged 319 points. That's 2.2%. That was almost the whole gain for the week. It did drift higher for the next couple of days, but it was a broad-based rally. Investors were looking for, waiting for some key inflation data that came out later in the week that actually was kind of mixed. We had a little hotter than expected CPI numbers, which is a consumer price index. That was coupled with a dip in jobless claims, which means the job market is still strong. And that then we saw the market initially sell off, and then it came back as rates went higher. Then they pulled back a little bit, and then Friday's PPI report balanced out that CPI number, and that pushed yields lower again. That was combined with kind of a mixed bag from the big banks. We're seeing, yeah, the earnings were okay. JP Morgan had pretty much a record quarter. They're expecting a great year again this year, but in general, we had some forward guidance a little bit lower by the banks and also some other companies that have been starting to report the fact that they're expecting expenses to kind of weigh on earnings and revenues going forward. So that was a little bit of a mixed bag. Yields ended the period lower. The 10-year, which has been flirting with 4%, go back and forth on that 4% number, ended at 3.95, but the 2-year slipped all the way down to 4.178. That was the lowest level since last May. So that was something that, helped prop up stocks during the week. We did get a little bit of higher prices in oil. It's surprising that oil is not higher than it actually is. Part of that is due to the fact that we're getting buildups in supply from the non-OPEC countries. So if this was probably a year or so ago, I think you'd see the crude oil prices up over $80 again. And if things do pick up over there, we could see higher energy prices again. So kind of keep an eye on that. The market sectors were mixed, with this big cap technology shares coming to the rescue last week. We saw technology and communication services outperform. We also saw strength in healthcare, which was that's lagged the market for the last year. So technology is very close to a new high. Communication services did make a new high. And then on the opposite side, we saw weakness in energy and utilities and materials. Nothing big there. But the major averages basically were up for the 10th time in 11 weeks, except for the negative divergence in the small caps and transports. So that's something to look at. Technical condition is mixed at this stage. As you recall, we went to a bearish position on the market posture on the 5th. I guess that was the previous Friday before that. And as of this morning, right now, it's actually down a little bit from where we went bearish, almost flat. So not a big deal. As far as the technical indicators go, well, MACD, which is a short-term trend gauge, is bearish for the major averages. But with last week's gain, we did see it, for the S&P 500 and the Nasdaq, especially, start to move more towards a bullish cross. I'm not sure that's going to happen. Momentum measured by the 14-day RSI and the 9-day RSI remains positive, but it certainly has slowed. You had that big bump up on Monday, which helped the momentum in NASDAQ, but it did little for the other indexes. So momentum here is just kind of going sideways. The down, we'll keep an eye on that. Again, the secondary indexes, which we like to see lead the market higher and lower, they continue to deteriorate. And like I say, with the small caps now down for a third consecutive week, it was way overbought. I think the Russell 2000 was up, what, 25-30% or something like that off the October low. So, I mean, it had really surged higher. It was due for some pullback. But you do want to see that, you do want to see it bottom out here and just kind of firm a little bit. Where Market Edge opinion still is long all the indexes except for the energy sector. So again, I mentioned that the XLC, the communication services, posted a new high, but technology and healthcare and financials are also close to a new high. So it's we that kind of points to a broadening out of last year's rally, and it also points out the fact that it mostly remains intact for the most part. But again, going back to the small caps, you've had them pull back 5.8% of their gains from over that rally, and that's a little bit worrisome. So if we we opened up today a little bit lower, nothing not a lot of info out there. Global stocks were lower this morning when I checked. That's something to look at. I think Hong Kong was actually down about 2%. They're still worried about their economy over there. But I think what you want to look at here, if you're waiting on the sidelines just a little bit to maybe nibble away at something if we have a pullback, I still believe that 4,600 on the S&P 500 is an area that we could see a little bit of a line in the sand. That was basically where the July high was for the S&P 500, and it's also where on the way up we kind of struggled going sideways for about a week or so at that level, and we broke out. We went a lot was sharply higher for that. Now for the Dow Jones, I think support for that comes in around 36,250. Which see we went to a bearish call at 37,466. So I'm not looking for a big sell off at this stage. But once we get down to these levels, they need to hold because after that we've got some gaps on the charts that could be filled, which could actually be a little bit sharply lower from here. Now the Nasdaq bottomed out at 14,477 the previous week. Our support on that was 14,400 that we had published about 2 weeks ago. So that got close. And if with these big cap technology stocks, if we start to see them roll over, we've got Microsoft today making a new high, and Nvidia still making a new high last week. They're still leading the market. But if it becomes a problem with the weightedness of those, you could see the Nasdaq maybe sink down to a deeper sell-off around 14,160. That's in line with the 50-day moving average, and that's something that we would want to look at. Sentiment actually we saw kind of back off a little bit. It was actually at extreme levels here about 2 weeks ago. In fact, the MarketEdge sentiment index was the highest it's ever. Well, in our case, it would be the lowest. It was a -9. Been doing this with MarketEdge since '98, I think, 97, 98, and I don't recall it ever being that low. So that's just a sign that when you get these indicators like that are extreme levels, they do become contrarian indicators. And the reason that is because if everybody's bullish on the market, that means they're already in. They've got their money committed. They love it. We're going higher. This is where you want to be. Well, it's a contrarian indicator to that point because if they're already in, who's going to throw more money into the market to make it go higher? So that's something you also want to see. But we have seen that back off. In fact, going into the new year, it was actually kind of surprising the National Association of Active Investment Managers had been on margin last week of December. They were at 102.7. And then the first week of December, they actually dropped off, whether they were rotating or making up new positions for their statements or whatever. It actually dropped down to 71, which was a big drop off. That was probably the lowest exposure to equities they've had since mid-November. So they were buying all the way up through that. And then they added again last week. They went up to 80.2. So they're starting to nibble away in here. Maybe that's why we saw the big caps take the lead last week. I'm not sure, but anyway, the sentiment index is now negative at -5, and that's up four notches from the extreme levels that we saw just about 2 or 3 weeks ago. And that's something we want to see. Short interest ticked up a little bit, which especially is interesting to note. NYSE short interest was up 0.8% the period ending 12/15. That should come out probably this week, the latest read on that. And that's something we want to see. We want to see if usually short interest is measured, it's something that the hedge funds do more than individual investors. I know individual investors do that, but we want to see if they're still shorting the market here as we're approaching new highs again, or whether they're covering their shorts. Because if they start to cover, we could go a little bit higher. We'll see how that comes in. But anyway, at this stage, we still are bearish. There's things that we're watching, especially with the negative divergence in the small caps, giving back some of what they have. Today, the small caps are, yeah, they're actually, the Russell 2000 is down almost 0.75% today. The other the major indexes are kind of mixed. With the Nasdaq opened up down about 80 points, but it's actually flat right now. And the Dow Jones was down about 250. It's down about 135 right now. We'll see whether these gains hold. But Nasdaq now it's up 27. So again, if I'm looking at some of the quotes here on my screen, again, it's except for Apple. You have Google up today. You have Intel's up today. Microsoft is up today. Microsoft is up about 1%. It's making a new high. Nvidia is making a new high. It's up 3.5%. So that's kind of what you're seeing today. Again, it's a handful of stocks on the Nasdaq that are leading the way higher. The turnaround here today in the Nasdaq, and if you look at the market diary with the Nasdaq, all of a sudden turning around, you're almost 3 to 1 negative declining issues to advancing issues. Volume is about you still have more declining volume than advancing volume on the Nasdaq, despite the fact that it's just turned around and pushed higher at this stage. So I don't like exactly what I'm looking at, and with the underlying breadth for the market, that tells me that this last upward motion that we're getting is a little bit iffy. So I would be cautious in here. I wouldn't be looking to buy until we see this thing start, whether it's going to break or whether something happens that you see it run up. Today we saw the Empire State Manufacturing Index come in at -47. Let me see, -47.1. They were looking for a -5. That was the lowest reading since May of 2020. So that was a disturbing number for the market. That's why we sold off so hard at the open. And again, most of those bulls out there are still counting on rate hikes to prop up shares. And I didn't check. I should have checked before we got in here. But that Empire State Building or Empire State Manufacturing Index may have actually pushed up the odds of a March rate hike higher. But I think that you need to watch out for that, because when you start talking about 6 rate cuts over the course of a year, that's not just to get because inflation's in check. That means we're probably headed for a recession. So don't get too excited about they start talking about 5 or 6 rate cuts this year, because that's not necessarily a good thing. So yeah, I'd be cautious, here over the next week or two.
Okay, actually, speaking of market breadth, that brings up a good question that I have, David. You mentioned that breadth is not supportive of higher prices, and I also see that the market is down today. Can you explain a little more in detail about that?
Yeah, Carla, let's go over go to the homepage, and I want you to click on market recap. And this is something that we have on the site that really gives you a nice snapshot of what's going on. You can see the different indexes, how they're moving up. And of course, you get down here to the Russell 2000, you can see it's been a pretty rough, pretty good drop off. It's trying to find support there. Actually, as we look at that chart, you can see where we gapped open up there sometime in December. When you see these gaps on charts, a lot of times you'll see the indexes or stock fill that gap. And then once it fills that gap, traders will watch to see, okay, it filled the gap. Are we going to start back up or are we going to continue lower? On the same aspect, if you go down just a touch on the transports, you'll also see that it filled that gap and it's trying to hold right there at that where the gap took place. And we'll have to see if it does because you can see there we're getting closer to the. But we'll have to see if whether this holds. If it does start to roll over, that could be trouble for the. Which could be a warning for the market. Where we're probably going lower. Now click down to the on the page here to the AD lines. Okay, so we have the NASDAQ last week up 3%, and we have the New York about flat. Now, market technicians look at the AD line as a leading indicator, and in this case, and there's two ways to look at it. Number one, the NYSE AD line is more of a predictor than the Nasdaq. The reason for that, you have a lot of junky stocks in Nasdaq, and if they when the market begins to slow down or go sideways, you'll see a lot of people sell off their junk, and that's why you're seeing the AD line go down. But still, as it's going higher, the AD line's moving lower. That's just showing you that once again we're seeing the large cap tech stocks leading the way for the market, and that's not what you want to see. You want to see this, as you look on this line from 11.9 last year all the way up to that peak here on the right side of the Nasdaq. That just shows you that people are buying a lot of stocks. It's a broad rally. The 80 lines are showing that a lot of stocks are being bought. More stocks are being bought than sold. Now over on the New York advanced decline line, as the NYSE is kind of going sideways, with the Dow Jones kind of going sideways. Like I said, we went to a bearish call on at 37,466. And as of today, as we're speaking, we're at 37,390 at the moment. So it is moving a little bit lower, and the AD line is showing you that it's not a real sell-off yet. But come in here and take a look at this every couple of days. I mentioned it in the daily commentary. Rich does too. But if you start to see this NYSE AD line start to look like the NASDAQ AD line, and we're still going sideways with the S&P 500 and Dow Jones, that is a negative divergence that you don't want to dismiss because that's going to tell you that, hey, the majority of the stocks are going down. It's a thin rally that's keeping it higher at this stage, and you won't get any better warning than a falling AD line. And historically, that has topped out about anywhere from 2 weeks to maybe sometimes even a month or so before the actual Dow Jones or NYSE will top out. So you want to keep an eye on that. If you go down, even look down at the bottom, you'll also see that back in this November and December, the new highs and new lows on both of them were way higher than what we were seeing on the new highs versus new lows. You saw those big jump up in there. That meant people were buying these new stocks. So that's something that you want to keep an eye on. Go down a little bit further, Carla, and let's take a look at the volatility here. As you can see, we're way low on this volatility index. I would, if you can look at some things, we have some, I think it's VVIX. There's a couple volatility ETFs that you can buy. I would look at that. Today we are up a little bit. We've been inching up slowly here recently. Today we are up 50 cents. So today we're up another 3.7%. I think if you see the VIX on the market start to get up here towards 14.5 to 15, that's going to be another sign that, okay, we're starting to get a little bit more fear in the market here. And that means the traders are starting to think, okay, they're starting to put more premium into options, which means that they're afraid that we could be seeing a pullback. So that's a couple of things that you want to watch. Again, I don't see the underlying breadth supportive of us breaking out to new highs here over the near term. Something could happen that we see, but I would be very cautious in here on that. And that negative divergence in the underlying breadth is something that you want to take seriously. And this market recap page would be one that you can kind of keep an eye on that. You don't need to check it every day, but every 2 or 3 days, come in there and take a look at that, and that's going to pretty much tell you that whether things are firming up or whether they're starting to decline. So that let me leave you with that, and I think that would give you something to look at here that's very important over the next week or two.
Awesome. Well, that is extremely helpful. I know that you mentioned that you cover the market breadth in the daily, weekly, and also monthly letters that we put out. But in case you're a DIY user and you'd like to take a look at it yourself, this is how you can do it. So, David, I appreciate you walking us through that. And we are actually out of time for this week. So, David, thank you again, as always. And
Okay.
have
Yeah,
to.
and again, maybe Carla, maybe show them where the daily market comment is, and on if we can actually go to that just for a second. Okay, when you come onto the homepage, you'll see the daily market comment right on top. But if you click on that, the second paragraph, we talk about breadth. Okay, we're talking a little bit about breadth was mostly negative for a third day in a row last week, despite the Nasdaq being up 3% on the week. And then you had the VIX. You can see on that was starting to inch up a little bit. You also get the price of crude oil on there, what's happened with gold and Bitcoin. But mainly, look at that. Again, you have more advanced issues on the NYSE by about 5 to 4, but declining issues again for third day on the Nasdaq, and that is something and declining volume on both of them too. So that is something that you want to kind of keep an eye on, and you can do that daily by reading that. And we'll touch Rich and I will touch base on some economic data that's released, and also we'll just kind of give you a little touch on the earnings of what came out and any problems that we see in the market.
All right. Well, thank you again, David, for all the helpful information for this week. We have to wrap up this week's Tech Talk Tuesday, but thank you to all of our listeners, and we will catch you guys next week.